what happens is people get, they end up saving either part of their assets on either side. Normally it is qualified, right? And to go over these, certain assets, we're talking about 401ks, 403bs, TSBs, right? IRAs, Roth IRAs, simple IRAs, SEP IRAs, right? All these types of funds are called qualified funds. And what that means is it's basically governed by the IRS. Okay, the IRS overlooks these funds and they give you certain, let's just say, strategies or implications, and a lot of times advantages, right, for the tax deferred or maybe tax free into a Roth account. Okay, so these kind of accounts are kind of governed by the IRS to where they're giving you advantage to save for retirement in different ways, right? The non-qualified side, we really get into after-tax money. Okay, so, and what I mean by after tax means you make your salary, okay, let's say it's $100,000 a year, okay, you pay the IRS, let's say you either paid inside or after, right, when April comes around, and you have, let's just say, $80,000 yet left of net, okay, that is after tax money, right? Your pre-tax money is going to be, right, you contributing, or your employer and yourself contributing to 401ks, 403bs, and TSBs, things like that, even 457bs. But the bottom line is that the majority of retirees, right, they're saving up these funds through these qualified funds and really matching employer contributions with them to tax defer until they retire. And the whole point of that, right, is to be able to save a certain amount of funds to be able to use to supplement what, Steve? Supplement income, right? That's the big idea. We're going to kind of get into that later. But again, these qualified funds are the most important part of the pre-retirement and then when you retire, okay? The most important part is understanding what these are, how to use them, and how to kind of manage them when you retire or getting up to retirement, right? I always say that the goal is 5 to 10 years before you retire, right? 55 to 60 range. You should really be looking into what plan do I have individually to be able to supplement my income, and how am I going to be able to take money out or use it as income out of these funds to be able to get there. Now, the non-qualified side, I'll touch a small portion on it, but you're looking more at the CD range, money markets, right? Brokerage funds, cost basis. And I know I'm throwing out a lot of words, but that's more about the stuff that you have. Let's say you buy a stock when you're young and you've been holding on to it forever. More of those capital gains come in, right?
Well, David, yeah, if you think about the qualified versus non-qualified, the easiest way for people to remember that, qualified have no preferential tax treatment. So you can invest as little, as much as you want for non-qualified money. So when it comes to qualified, that gives the title. There's certain guidelines, and the government is pushing people to fund the qualified accounts. The main reason, quite frankly, is because there's less and less pensions in the workforce today. So I read something not too long ago, a couple of decades back, 60% of the people that were working had a pension set up with their company, and now it's less than 20%. So, what are people doing to supplement that pension income? They're creating these qualified accounts. And the way it works is you get tax credits. So you're putting money into these qualified accounts and you get not counted as income. And then down the road, when you retire, you use it for income. So I think whenever you hear the word qualified, that's really your account that you're creating for income when you're retired. And I think that's where we have to identify the difference between non-qualified and qualified.
Right. And those qualified funds, Steve, those are made for you to use. And, it's funny because in our seminars, and when we talk to a lot of clients or even people that are asking questions on the show or calling in, you get a lot of questions saying, well, what if I don't need it? Or what if I don't want to use it? Those should be the first funds that you should be using, is the qualified funds. Okay. And if you're going to transition that and pay the taxes off, then there's other plans or the ways to kind of put those away. But again, if you have qualified funds, okay, you need an individualized plan for those funds in retirement. And that's what we specialize in. And if you need to sit down, where really everyone needs to, but, the one biggest thing is people make a lot of mistakes on when to take them out, how much to take them out, how Social Security is involved in those qualified funds, right? Because income brackets come in, tax efficiencies come in. That's the big plan. Okay. So, if you're pre-retiree or getting retired, you need to give us a call, 850-565-1705. We'll sit down with you. It's completely free. We go over a full plan with you. We sit down, we show you really how to utilize that into what your goal is in retirement and individualize that plan, right? Because that's the most important thing. Those TSBs, 401ks, IRAs, many people make a lot of mistakes when it comes into retirement about how to use them, when to use them, and sometimes they never even get the full benefit out of those funds. And Steve, we see that all the time.